Alright, in this short video, what I will do is provide you a little background on some of the things you might have picked up on going through the financial statements for Home Depot and Lowe's. These aren't the only things, and I don't expect everybody to find the same stuff. I don't expect everybody to find the complex stuff. These two companies are actually really similar to one another, and if we look at a comparative balance sheet between Home Depot and Lowe's, it's hard to find any substantive differences. What we see is Home Depot tends to have slightly more cash. They have some accounts receivable, so cash and accounts receivable runs about 8 or 9% of assets. And over here at Lowe's, they're not even showing any accounts receivable. That doesn't necessarily mean that they don't extend trade credit. Usually when you see something like this, it means that they sell the trade credit to somebody else. I don't know that for sure, but that's usually what it means. But we see that the current assets, slightly higher proportion of assets for Home Depot than for Lowe's. Notice how similar the inventory is, because these two companies are really the same two companies. We also see the property, plant, and equipment. This is their buildings and facilities. Very similar in total. And so the other major thing I saw in here was there's a difference in goodwill. Goodwill usually means that a company bought another company, and we don't see any goodwill over here with Lowe's, and we see some over here with Home Depot. But by and large, those are very similar balance sheets on the asset side. Now it gets interesting on the liabilities and equities side. If we look at accounts payable, very similar for both firms, and that's probably indicative. The accounts payable are what you're replenishing inventory with, so the two companies are really very similar there. Where we start to see a bigger difference, though, when we start looking at long-term debt, Home Depot has added more long-term debt. Note it's gone from 27% of assets to almost half of assets over this 5-year period. We see Lowe's has increased their total long-term debt as well, but not to the extent that Home Depot has. And total liabilities for Home Depot are now 85%. That's really high. That's a large number for a company of this type. That doesn't make it bad, it makes it abnormal. If we go down here and look at what they've been doing, they've been raising debt. They've been borrowing money and using it to buy back shares of their own common stock. The retained earnings is a higher percentage, but that doesn't really tell the full story over here. Okay, so what I want to do now is flip over here and look at Home Depot, their actual statement, and look at the change in retained earnings. That would just be this year's retained earnings minus last year's retained earnings. So in the year ended January 2016, they added close to $4 billion of retained earnings. The prior year closer, and so it was 3,344. If we look at the net income for that year, remember that retained earnings is the cumulative net income minus cumulative dividends. If I add a line here for the net income, what I can see is that if retained earnings increased less than the net income, it must be because they paid a dividend. And then the last thing I want to show is the change in Treasury stock. And we can see from these figures that even though Home Depot is adding a lot of money each year, for instance, this year they added $7 billion in net income, they didn't keep all of it. because they paid a dividend of roughly $3 billion, and they use some of the money that they have by raising additional long-term debt to buy back shares of stock. They are increasing their financial leverage, and that's a pretty big deal for most companies. All right, that's a large change, and one that I would, again, not necessarily good or bad, it's just not something you usually see. You don't see the same thing here with Lowe's. You see that their retained earnings are actually going down. That's because they're paying a bigger dividend and they're not earning as much money. All right, the other thing that we see if we look at the income statement between the two companies, very, very similar cost of revenue. That's because they sell the same products. Home Depot has some economies of scale, and therefore they have lower selling, general, and admin as a percent of sales, which makes them slightly more profitable. But slightly more profitable is basically double, and that's a pretty big difference for these two companies.